that is the amount of dollars spent in strip joints. No,
You know,
no, no,
you,
no.
you and
This
I have gone out to dinner a lot, and the last place we've ever gone was a strip
last
joint.
place. Yeah. It might be a proxy for the goodwill of the Trump brand.
Don't base your trade on some guy jerking off on Reddit about how we're going to kill the shorts.
Wait a minute, you forgot to say in his basement. You like to say that.
In their basement, yes. Welcome to another edition of Risk and Return. I'm Charlie Gasparino, columnist for the New York Post, Fox Business senior correspondent. I'm here with my partner, the granddaddy of data, Bob Sloan. We are both of the S3 partners. By the way, if you notice, we're both wearing S3 swag. And I was gifted this to Bob as part of my commission. But in any event, S3 has some good stuff this week. And Bob, what we have this week is where, and I think you'll be able to unpack this, where the battle lines are being drawn between the longs and the shorts on a handful of really prominent stocks. So why don't you just take it away? Just list them and let us know where it's going.
Well, this week, first of all, Charlie, I must say, you look very dapper, very, 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 very professional in your S3.
See, finally,
S3 vest.
finally, I look professional on
look
this show.
Super sharp. So thank you for that. But in all seriousness, there are lots of battlegrounds. Now, we on this show broke the idea of what's the difference between a meme and a battleground.
Right. And let's go through that. Meme stock, heavily shorted, mostly retail, right?
And right. Heavily shorted without an institutional long presence.
Right. So it's the longs are mostly retail. It's
Yes.
the guys that trade in and out, the Robinhood crowd in and out. And you can break down that data. And that data matters because it tells you a lot about how the trading is going to go, who's going to come in and, try to capitalize on unfortunately, the meme crowd doesn't have the same information that a trading desk guy has. And after the one episode of Melvin, was it? I keep getting the name wrong.
Melvin
Going
Capital,
down
right.
under, following massive losses on the meme stock GameStop. Remember GME? Really, the sophisticated trading desks played the meme crowd pretty well, knowing where the short interest rose, knowing where to trade in and out of stocks, and kind of trading up and down, all the way down. If you know, AMC now trades at the equivalent of 30 cents on the dollar. A battleground stock is there are shorts, but a significant real long presence from institutions, correct?
Correct. So what we did, and it's really kind of a crazy thing. We on this show we talked about what's a battleground stock. Now, battleground stock is when the institutional longs more or less equal the institutional shorts.
Right.
And so there's a ratio. And when that's 1-to-1, when the active long, you have to cut out all the passive and you have to cut out retail because they tend to hold their positions. And when you look at institutionally who's involved versus the short selling community, if that's 1-to-1, that's a battleground. You can tell that's where the action is. There's going to be an explosion, usually within 90 days.
Up or down, right?
Either way, because it's telling you that what's driving the stock price and what's traded every day, there's a dollar long and a dollar short. So if a dollar more comes in on the long side and it becomes $2, the stock's going to go up. If, let's say, 50 cents comes on the short side, it's probably going to come down. So what happened, we talked about C3AI. And we said, this is a battleground stock. It's skewing short. It was down like 30% this week.
Oh, okay.
Right. So these ratios, long to short. Now, long $100, short $100, that's a ratio of 1-to-1. If you have short $70 and long $50, it's probably about a 0.8. So we have ranked and categorized the entire stock market, looking at it through this lens. And that's the difference between a meme and a battleground. Now, that explanation got 407,000 views on X, just on an interview of one of the shows we did together, and then I did a piece on Bloomberg News. So this is news. People are not used to looking at the markets this way. It's new data. It's a new way of looking at things. And this week we have seen what happens when that long-short ratio, institutional active longs, either exceeds or is a little less than or a little more than the short interest. That ratio, when it moves stocks. A lot of interesting things have happened. So let's take, roll them please, DJT, Trump.
You know what that is.
Yeah. So as you
that's our president's
yes,
Truth Social, the holding company for Truth Social, our
right,
president's social media platform.
right. And so you can see on the chart, the blue line is the long-short ratio. What do we see? We see the institutional longs have piled into this stock. It's 2 or 3 times now the short interest, which was not always the case. Short interest was actually more over time than,
Oh yeah,
right? So the stock price is, more or less come down. It's kind of more or less found its level. But you can see the institutional longs are plowed into this stock in the last couple of months. So we think this kind of bodes well for this stock. You've seen the institutional longs are plowed in. The more they plow in, probably you see an uptick in this stock.
what's the fundamental play you think on this?
Oh, I don't think there is one.
It's Trump, and
Yeah, it's Trump.
you know,
Look,
be
you
end
know
of
the
eight.
media business way better than I do.
Well, I'm just wondering. Well, I'm just wondering. Like, the company doesn't exactly make money, does it? Or
No.
yeah, that's what I'm saying. So the people are plowing in because I guess it's kind of a bet on the Trump presidency that most people think. I know we're only 6 months in of a 4-year term, has been net very positive. So it's kind of a fundamental statement on that, I would think.
So if we can bring that chart back,
And by the way, that's a scary reason to buy a stock, just so for the
100%.
people
I
out
mean,
there.
and let's be clear, we're data. We're not giving you
Oh
investment
yeah,
advice. We
absolutely.
say that on our X accounts. But this is what the terrain says. So if you're looking for a poll on the Trump administration, this is not a bad one.
Yeah,
It's an interesting one. People are voting with their pocketbooks and saying, we like this.
yeah, because you wouldn't buy the fundamentals aren't great, and even though Twitter still gets a lot more traffic. We can go down the lines. So that's it. I haven't heard the story of the longs of the institutional longs overtaking the short. That's a news headline, and just for the people out there, the fact of the matter is there's some corner that was turned that S3's data just came up with, and that corner is that no longer is this like the stock everybody's betting to fail. In fact, more of the smart money is out there betting it's gonna. Marginally
Succeed,
more. Not,
succeed, or it has value, and
yeah.
it might be a proxy for the goodwill of the Trump brand.
Now we did have a bad PPI number Thursday, so who the hell knows what the future. I always tell people this about the Trump presidency because a lot of it's going to hinge on tariffs. And if you're divining sort of the future from each quarter now, at least what's going on now in terms of economic numbers, the PPI, the CPI, the jobs number as they're coming out now, I would just say that's a fool's game. This is the next 6 months. Let's talk in 4 to 6 months where those numbers how those numbers look, and then we'll have a better sort of grasp on whether the tariffs were net positive or net negative,
Totally true.
and
What
and whether the big beautiful budget and the sort of stimulus in that sort of outweighs the tariffs are a tax, the tax increase of that's passed on to consumers and shareholders of tariffs. So be that as it may, we saw Wall Street is obviously liking what they see out of Trump, given given this battleground stock way. You were mentioning a few other battlegrounds that I thought were interesting. Go for it.
well, just as an addendum to what you're saying, and then we'll get to Rocket Mortgage because that's what's next on
Yeah,
deck.
that was one.
That's one deck because that's an interesting proxy on mortgage rates and home ownership, where the long-short ratio is going the other way. But just as an add-on to what you're saying about tariffs and the unknown, two things caught my eye that are, I would say, esoteric data points that are really interesting. One is something called the RIC index, RIK. That is the amount of dollars spent in strip joints.
No, what?
Yeah. And it's
I
an
did not expect that out
absolute,
of your mouth, my friend.
no, no, I'm serious. This
As
is a
someone who,
no, 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 no.
you and
This
I have gone out to dinner a lot, and the last place we've ever gone was a strip
last
joint.
place. But it doesn't mean that it's not a proxy for disposable income as it correlates to how the economy is
Now,
doing.
is this? Let's just back up a little bit because I've never
This
heard
is
of
a
this,
real
and I've
thing.
been
No, no, no.
I've
This
been
is
around
a
for
real
years.
thing.
Is this something that Wall Street looks at?
Yes.
It's called the RIC.
Yeah. RIK.
What does that mean?
I have no idea, but I know
There's
what
no
it is.
stripper. There's no stripper.
No, there's no poll. Okay.
No, but there's no. There's got to be an acronym for something.
Uh, who knows? Okay. All I know is it measures the amount of disposable income, I would assume mostly men, that spend on strip joints. And this has fallen precipitously. So it is a measure of disposable income being spent. It's and it correlates with recessions almost like every single time. So that's one data point that's, I think, very interesting. The second is this
Okay, so I just looked it up. It's that, but it's a few. It's the RIC. Is it the RIC? RIK or RISK?
RIK.
All right, go keep going. I'm sorry.
Yeah. So look at that. And it correlates to recessionary behavior and recessionary markets. It does. And people look at this. So that's one. The second thing is the CPI for electricity has gone off the charts. The demand for electricity. And who is building the most nuclear power plants in the world? It is China. They have built 29 they have under construction. I think we have one. So AI and everything that's going on in terms of building data warehouses, data plants, data everything, energy for data, they already have 29 nuclear power plants that take 5 to 10 years to build under construction. We have one. The CPI for electricity has gone through the moon. So there is, Charlie, to your point, this idea of a VAT, a VAT, a value-added tax, which really what a tariff really is.
Yeah, it is. It's a value-added tax. Yeah.
And we called this out to raise money, put in the treasury so you can balance the budget. It's a fight between what do markets care about? If you basically balance the budget, but you have higher inflation, how does it all shake out? What happens?
Also, it is a static number because what we don't know is if the tariffs are going to lower economic growth. I mean, there's a good chance. I mean, some people are predicting stagflation. I heard Austin Goolsbee did today. As you know, I think he's the Chicago Fed. I could be wrong.
That's right.
But
Head of the Council of Economic Advisors for Obama.
Obama, yeah, the top person. By the way, the RIC index, just for our viewers out there, is according to AI, it relates to the stock symbol RIC Hospitality Holdings, RIC.
Yeah, hospitality
Company
holdings.
that owns
That's
and
euphemism
operates
for that.
upscale adult nightclubs and restaurants, including brands like Rick's Cabaret. Okay, so there you go. Some observers, often in a humorous and anecdotal way, aka Bob, refer to the performance of the Rick stock as a sort of stripper index in predicting economic recessions. You know, I've learned so much from you, Bob, but this one is the best lesson I've had. I'm going to be looking at the strip club index for a long time.
It's a crazy thing, and this is what Wall Street does, right? It parses through data that seems unrelated, or you say, oh, come on, how can it be real? But it does. And then you build a case. So let's go to mortgages. Now that we've talked about inflation, let's go to Rocket Mortgage and the long short index there. And what we've seen with Rocket Mortgage, you've seen a real buildup in short interest, very bearish sentiment on this stock. And if we could pull up that chart, that would be great. Thank you. Now you can see what's happened, right? The stock price is more or less flat, but the amount of shorts as compared to the long, shorts outweigh the longs now. You can see on the upper left, the long is more than short. On the bottom right, you see.
Now, I just read a story in the journal that mortgage rates are down dramatically. Does that have anything to do with it?
People are bearish on the stock. You see a lot of short interest building, and you see it. And this is also that long short measure. Again, it's the measure of active money, long versus short, day to day. This is where the action is. Shorts dominate the action here. So if you get bad news or you get a bad inflation print,
We had that today.
you'll see a higher consolidation in short interest.
Let me ask you this: you saw the PPI number.
Yeah,
You think it stops the Fed from raising rates, or cutting rates, I should say?
I don't care how much they jawbone them, they can't cut it to that number.
Will they cut it 25 basis points?
Why?
I don't think they should, but so you don't think there's going to be a rate cut?
I fixed income, I've probably, I'm like with most people thinking that the bond markets have predicted, 20 of the last 12 recessions, right? So,
Which is not the worst average, to be honest with you.
yeah, but I mean, it, 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 it's very hard to say that is the Fed chair that immune to job pressure, public pressure, jawboning, not to do something. And we saw that, and you covered it better than anybody else with Yellen. Hey,
Right.
this is, she more or less said, okay, I have to do to save my job, and then there you go, right? So
And she
that's
cut away, kept rates way too long. Right. I
yeah,
mean, she during the Obama years, she was insane with rate cutting.
100%. She was insane with rate cutting and was very sensitive to the Biden economic policy. There was
Well, when she was
no,
Treasury Secretary, yeah, yeah,
well, but so what? I mean, at the same time, she had influence, and she was
and she
out
did,
there.
she did.
She did, and she was out there talking
Transitory inflation, don't worry about
all
it,
that.
and
All,
that gave Powell cover to keep rates low when he was in the Fed chair.
all
Um,
that.
Fascinating stuff. So I think you're right. I don't think he's going to cut. You
I don't
know,
think so.
I think this is going to be. It's the politics will play out. Any other stock picks before we get into some heavy duty, you know, public policy issues?
Um, Palantir. Palantir has been the darling of retail stocks. Now, this is not a long short ratio stock because the longs are so much, right? Longer. There's so many more longs than short. And I saw something, I saw Chanos remark about how someone said, oh, everything, as we were talking before, everything's a meme stock right now. Right? It must be, and it can't be that there's slow news because the Trump White House puts out news every 5 seconds.
Oh, it's like
But
nonstop, right?
it's
Yeah.
nonstop, right? And a lot of it is surprise, like Intel. Um, but this is this is a stock where there's 18 to 20 times the active longs than there are short. So everybody's long. Apple, same thing. There's 15 to 20 times on any one given period, times the number of longs that are short. Now, as a dollar amount, sure, there's a lot, 20, $30 billion short. It's a big number,
Because it's
but
a
it's
big market
nothing.
cap stock. You expect
Yeah,
some shorts in this,
yeah,
right?
but it's
Just
1%
for
of
hedging
the float,
purposes.
1% of the float or something like that.
Yeah.
It's meaningless. You can't have a meme stock squeeze in these stocks. So Palantir, everybody's like, oh, there's a squeeze in the stock. There's no squeeze in this stock. None. Zero.
Yeah, I mean, squeezes like when you can't borrow it, right? I mean, these
Well, there's a
stocks are
lot of things that
eminently
has to
borrowed.
happen, right? The short community has to be losing money. Okay. They have to be losing money. That's number one. Number two, there has to be, as you said, the supply of the borrow has to be one, tight, and two, very expensive. And three, you have to have company. It has to be crowded.
It reminds me of when AMC, even after the short squeeze was over, started popping. It would pop. I mean, popped as high as $70 a share in 2021. I remember this because I was covering it, and it was and all these and the AMC apes would run around, short squeeze going on. It really wasn't a short squeeze.
No, not at that
If
point.
you went to any short sale, they said, I can borrow this stock like tomorrow. They diluted the hell out of these people. This is not a short squeeze. This is sophisticated investors writing their sentiment up and looking for ways to trade out of it when earnings come in and they're below expectations again, and they're losing or earnings losses, I should point out. And
That's
that's
correct.
kind of like what you have to look at with these stocks, and because you can't squeeze a stock that's that's eminently borrowable, right? I mean, you
Really
can't.
borrowable, and the market cap is so big, right? There's only $1.4 trillion in shorts in the entire world. The market cap of some of these, so in other words, you'd have to short the entire market to get to something where it would be 10 or 50, 20% of the float of
Yeah.
an Apple or these huge stocks. It's
Yeah.
just
So it got
impossible.
guys out there, if you're looking for short squeeze candidates, you know, don't base your trade on some guy jerking off on Reddit about how we're going to kill the shorts.
Wait a minute, you forgot to say in his basement. You like to say that, by the way.
In their basement, yes, because you got to look at the numbers. The S3 numbers would really help you out, I should point out, and you'll get the size of the float. Is it borrowable? And you'll try to understand what's going on. Is it a short squeeze, or is it just traders playing the short squeeze game, which they do all the time? I want to get to something that's fascinating to me.
Just one
You
more
would
thing on
Okay,
Palantir.
go ahead.
Let's finish the thought, and then we'll go. I'll throw it back to you. So in Palantir, the short interest, if we could show the black gap chart there on it, put that up on the screen. Yes, thank you. Now you see the stock price has gone, up to the right. The short interest has fallen like crazy. And so the only way the stock goes up is if there's more long positions going on. So if the long short ratio, our long short ratio goes from 18 to 19, meaning there's 19 more times longs than shorts than there were before. There were 18 in my example. The stock probably is going to go higher, but it's not going to go up because someone's trying to squeeze the shorts. And
Yeah,
you see this in the media all the time. They have no idea what they're talking about. They're talking about Apple short squeeze, no idea what they're talking about. Listen to us. This is the truth. We got it right. End of story. Now
yeah.
back.
We don't. Again, like this is why we're here. I mean,
Right.
we got the expert on the long short play here. Cut through all the bullshit. You
Here
come
it
right
is.
here. Speaking about cutting through the bullshit, I would think the market would be Intel stock would be crashing now, or at least Wall Street would hate the notion that the Trump administration is considering or likely. I'm not sure what the Bloomberg article exactly said. Just the fact that we're actually talking about this, a 7% stake in Intel. Now, the
And
last
that's
time
out of the sovereign wealth fund. How are they doing this? Do we
I mean,
know?
well, first off, a sovereign wealth fund usually is funded when you have surpluses, not deficits. But
Well,
that's
okay, the sovereign hedge fund then. Well,
yeah. I mean,
all
you
right.
think about it. What we're gonna do is we're gonna issue more debt to buy a stock of a chip maker that is kind of
Yeah.
iffy, right? But here's the sort of thing that is kind of getting to me. I'm a dyed in the wool capitalist. I believe in the capitalist system. Obviously, I believe in safety nets and all that. But when you start thinking government bailouts of companies, you do that when last resort, systemic risk, like if all the banks went under, except for JP Morgan in 2008, you would have really had a financial. By the way, what would that mean for you, the average person? Couldn't use your credit card because all the credit card companies borrow short term, and that's all what the banks do. If they're out of business, they're not lending, obviously. If you were getting a paycheck from any company, that's based on short term borrowing. Your company just doesn't have the money laying in an account. People don't pay their bills like regularly, right? It comes in spits
Sure.
and spurts. So what they do is they issue short commercial paper to pay salaries every 2 weeks. So that's where the financial crisis would have destroyed the economy. It would have been just locked it down. It would have been a Great Depression. So
Yep.
you bail out the banks. Then they went out and they bailed out the automobile companies, the automakers. More controversial because they're less systemic, but I guess they want the GM or Ford. Which one was in worse shape? There was one of them that could have made it through, and one of them I can't remember. But they
I
bailed
think
out.
GM took the bailout and
Yeah,
Ford kind of sort of didn't or did
yeah.
it and paid it back.
So GM was really on the hook.
Right.
So you know the and correct me if I'm wrong on that, but there were auto bailouts. So, but again, last ditch thing, would have destroyed the automobile industry. It's as American as apple pie, and probably hurt the economy even more.
Yep.
Now we're in a position. Now we're out there bailing out a chip maker that is not doing too well, right? I mean, isn't that the whole thing right now? I mean, Intel's was trading almost as a penny stock, wasn't it at one point? Well, no, they're $24 a share. I'm sorry. Well, it went as low as
I
20.
I don't think it was a penny stock, but it dropped
Yeah,
a lot. Dropped like
it was below
78,
20. Yeah,
78.
penny stock's a $5 stock, by the way. But yeah, you're right. In any event, Wall Street loves this, and this is like dyed in the wool industrial policy. This is what China does, kind of, right? Takes stakes in companies, and the Chinese government controls these companies through what's known as golden shares. I guess that's what it's called.
Yep.
And it's like a I mean a 7% stake in Intel.
It's a crazy notion. So if we are, the Trump and Republicans have trashed the notion of solar investments forever. But now, if it's chips and it's a national security issue, we're okay with it.
Right.
So either they just made a better argument to the markets that a 7% stake is absolutely necessary, which is versus wind farms, which are not. And, maybe that's what the markets are saying.
Well, let me ask you this. Just help me out here. Intel has apparently the best chips, right? I mean, or they have they have the capability. I'm going to read a Bloomberg, or excuse me, a CNN, CNBC story. Intel's the only U.S. company with the capability to manufacture the fastest chips on its shores. Why do they need a government stake?
It's a good question, right? It's a
A
really,
government stake would help fund factories that Intel is currently building in Ohio.
it's a really good question. Now, maybe it's just a repositioning of the $50 billion under the CHIP Act that was left over and not allocated, and they decided to put it into, I don't know. We'll have to see the details. However, industrial policy, where does it end? Where does it begin? What's the rationale? Who controls? Where does it go? So I would toss it back to you because I think there's a great segue to talk about Fannie Freddie and some of your headlines.
Yeah, I mean, we are talking about industrial policy. I mean, there's no capitalist reason to do this. Um, they lost. I mean, listen, the stock is getting crushed
Yeah.
before any of this talk about government bailouts and help came. I mean, they lost 60% of their value in 2024, apparently. But if they're so great, and you know uh, they're in competition with Nvidia, I guess, and advanced micro devices. And we should point out Nvidia and advanced micro devices, they're paying Trump, the White House, 15% of their profits to sell the chips to China.
And so is NVIDIA.
And so is Nvidia, right? So th- that on top of the fact that we have this thing with Intel, on top of the fact that there is something called Fannie Mae and Freddie Mac. These are like entities that keep turning up like bad pennies. Like was that the show? I mean, what do? They are the sort of the engine of the 30-year mortgage market. If you believe that people should have a 30-year that banks should issue 30-year mortgages, they won't issue because it's a lousy business, right? Their money is locked in, so they have to get those loans off their books, and they sell it to these entities. They were created by the government, called government sponsored enterprises, and it's Fannie Mae and Freddie Mac. Along the way, I mean, this occurred over decades ago. Along the way, someone had the bright ideas like, okay, these are government created enterprises, but let's issue stock and let companies take a stake. Let's make them be public companies, but they were never really public companies. They were always implicitly backed up by the federal government if they screwed up. And remember, that implicit backup, I know this is getting a little wonky, allowed them to borrow at AAA government rates when we were at AAA. I guess now it would be AA or whatever it is, but at low government rates. So you borrow the money, you use that money to buy the mortgages, you package the mortgages in a bond, you
Yep.
sell it to a third party, and you make money off the VIG. And everybody's hunky dory. It just keeps going on ad infinitum. What happened was that whole government backups didn't, in reality, kind of set in. they kept guaranteeing risky and risky loans. The government demanded that the banks, make subprime loans because they want the government housing to be a right, not something you earn. Fannie and Freddie kept buying, the toxic stuff. And in 2008, when we had a housing crisis, they were essentially insolvent. Their stocks plummeted, and the government took it over, put it in conservatorship. Now, Trump, during Trump 1, sought to quote unquote privatize it. It never got off the ground because there's so much weird stuff with this. It's never going to be privatized because there's no business. So taxpayers are still on the hook.
Yeah.
Okay, well, if they're still on the hook and you're still gonna give it the implicit guarantee, well, then we're gonna make a bunch of rich Wall Street guys even richer because that's how the whole system works. Their stock will go up as long as they can borrow cheaply and sell and buy the mortgages and package the securitizations, sell it, and make the vig between the buying and the selling. And that's kind of what they're talking about doing now. And I'm just saying, my reporting in the Post is that I talked to a bunch of Wall Street people about this, and they think despite all the headlines you're reading, it's really not going to happen. And one of the main impediments is if there is an implicit government backstop, i.e., taxpayer backing this thing. Well, doesn't Congress have to approve this? I mean, Congress does have control over the purse strings, and so I mean, who knows? I mean, I can tell you that my sources close to the White House say Scott Bessent, the Treasury Secretary, and Trump himself, and Bill Pulte, who's head of the FHFA, which runs Fannie and Freddie, are very determined to make this a public company again, and recap and quote unquote release. But there's going to be a lot of headwinds. By the way, there's also I think $7 trillion in debt combined on both of their balance sheets. And Bob, you've been around Wall Street. You do an IPO of a company that has $7 trillion in debt. Who buys the debt? Is that part of the IPO?
It's a really good question, Charlie. First of all, where does it reside? How does it keep getting funded?
Well, it resides right now on the balance sheet of Fannie and Freddie that's being funded essentially by the federal government.
By the federal government. So
but if you do a
does that
30
implicit
billion,
guarantee go to where does it go? And
if you do a $30 billion IPOs, which they're talking about, presumably you can pay $7 billion down, right? But that leaves less money for the recapitalization, which you need because if you're going to do this thing, the rating agencies are going to look at you and say, okay, you only have X amount of capital, and you have an implicit, I mean, it gets very complicated. I think they just should keep it. If you believe it's a public policy goal to have 30-year mortgages, and we can debate that. Or some people don't believe that's a ridiculous expectation that people should put down 20% and have shorter mortgages, shorter time spans on the mortgage. But if you think we need 30-year mortgages, then this thing needs to be part of the government. Doing one of these half-pregnant deals always leads to disaster.
No, but you got to hand at least. I'll tell you one thing that's interesting. We're talking about industrial policy. At least we're trying to get out of this cycle of, okay, you're either for taxes or against taxes. Creating revenue should be the tagline. The government has many, many assets. We've talked about it many, many times on this show. There has to be a way that government, we've talked about the government has certain brands that are world class. They have certain assets that are one of a kind. They have certain investments that are one of a kind that can be privatized and or sold outright. So or private equitized. So if the government really wanted to shrink the deficit from 30-something trillion dollars and basically do an asset sale to raise 15 trillion, I'll bet you they could do it. And maybe this is a way to start that.
I was wondering if you added up the debt, all the debt, even the debt that's encumbered to certain assets that the government holds, and all the assets, would we be insolvent? No way, right?
No way. And you wouldn't be. You'd certainly not be bankrupt. You might be insolvent. So
well, what is insolvent?
You would have a cash crunch. You'd have a cash crunch, but you'd be asset rich.
Yeah. Okay. So we'd be insolvent based on cash flow. We would not be bankrupt based on a reading.
No way. No way. I mean, just think about all the things the United States government owns and its tentacles and its supply lines and logistics. And there's so many different businesses that are in the government that could be run privately. Now, is there $15 trillion in the world that will buy this stuff? Probably not. But over time, you could
You don't
do,
have to deal with it immediately either.
you
You
have
just
to
got
do
to
it immediately.
slowly do it. Yeah, I
So
mean, listen,
maybe there's a way to back into that.
I think Besson knows this. That this is he's looking for every which way to essentially scale down the deficit. Although I will say, taking a stake in, well, maybe they're looking to flip Intel when it gets back on its feet, and the stock is up to $50 instead of 20. I mean, that could be the game plan there. I could see, like, it's funny, the federal government now is a hedge fund. So, I mean,
But, look, in Japan, the government is one of the biggest investors in the marketplace. There are a lot of markets where the government does hold
they
three,
do run
5%.
surpluses, though. They do run surpluses.
Sometimes yes, sometimes no. But at the end of the day, though, Nvidia is bigger than I think every single European market except Germany by
Yeah,
by itself. So
yeah.
we have a gargantuan opportunity to be even bigger. And I think maybe that's the mindset. So one of the things also is interesting too is, and maybe we should trot out some of the introduction to your headlines so we can finish this off.
Yeah, I mean, that was one headline, the Fannie and Freddie. Um, and then I've been looking at debanking, and you know I, I I had a feeling that the banks were kind of being pressured by the Biden administration to zap out of their not take the account of a random evangelical church or a random gun manufacturer or something like that. I didn't until Trump came out and said he was debanked himself, and I did a deep dive into the story. And again, it's in the post I wrote about it. I didn't understand the scale of it. I mean, first off, the scale of Trump. Trump literally, I don't believe, but definitely J.P. Morgan and Bank of America wouldn't touch him after, and he was debanked. The nominal reason was
Yeah.
January 6th, and it was under pressure from the Biden administration's banking regulators. But a total of 12 banks debanked him. And he had to go to smaller banks. I talked to some of the people there. It was like crazy. And it sort of, the way they described it to me, it sort of filtered down into the sort of various relationships they had. So if Trump was running a property in New York, right? So he's not really the land. I mean, he's like, I guess, the landlord. He has a
Yep.
lease on the building, right? Someone else owns the land. There would be a bank account associated with that. The people that were in that bank, because that bank account people would pay in to pay their dues on their condo or whatever the hell he's running, that bank account would be debanked. I
Wow.
mean, it got. I just heard this was amazing, and then as I kept writing the stories, I got other calls, and a guy named Jerry Boyer, who's an old friend of mine. Jerry is an economist. He runs Boyer Research. They do proxy. They do a lot of proxy stuff, and what they do is they basically are doing proxy stuff and getting shareholder votes on trying to get companies to move away from woke policies. And
Yeah.
they're having like a lot of success. They're not winning the votes, but they're getting the debate that forces, even if after they lose the vote, the companies to change. So he looked at the debanking of evangelical churches on the grounds that they they sort of like stepped over the line on something, not the reputational risks part that Trump was booted for, but it was something about the a legit viewpoint. And a bank can't discriminate against you or me
Right.
based on our religious affiliation. They can discriminate against us based on viewpoint, or they could.
Hmm.
And they could say, well, if you're an evangelical organization, do you believe in same-sex marriage? And they say no, and then they turn around, oh, we got to kick you out because guess what? You're that's a form of hate speech, and that's what happened. And Jerry put it to a bunch of big banks, including J.P. Morgan, and got them to change in late 2024. Then maybe they saw the writing on the wall. with Trump coming in. One bank that didn't change, at least not initially, and not until recently, was Bank of America. So Jerry's telling me that Bank of America threw him out of his office, said, "Oh, we're not going to change the reputational risk. Go fly a kite." So I go to Bank of America with all this, and they confirmed to me that, yeah, a couple of weeks ago, early summer, we changed.
It changed.
We took
Interesting.
out that viewpoint aspect in our code of conduct, and just and said that we can't discriminate based on viewpoint, and therefore that religious sort of canceling is now over at Bank of America. And Bank of America is the second largest bank. We should point out JP Morgan is the country's largest. So hats off to Jerry Boyer. We should probably get him on the show to talk about this, which we will soon. Good guy. You'll find it fascinating on some of his efforts on taking on woke capitalism at the proxy shareholder voter level.
So last night, you and I had dinner. We had a great dinner at your favorite place,
Ilios
Ilios,
in Manhattan.
And we had a fantastic table. Great reporter from Axios, Sarah Fisher.
Right.
We should probably have her on as a guest.
We will. We will. Now, we are. I mean, I like having reporters on, but I like having newsmakers, and we're gonna have some good newsmakers in the next couple of weeks. So I would say everybody stay tuned. I don't want to pre-announce it and they don't show up, but we could be making some headlines in the coming weeks. So just keep watching us. I'll be posting on X when we got someone good. Do you just change hats again?
Well, we're going to run a little A/B test.
Anyway, Bob, that's it
what we
for
do
my
in a data company. We run A/B tests all the time.
You do. That's it for me, and I think that concludes another riveting edition of Risk and Return. Again, keep watching us. We had Curtis Lee on last week, Republican mayoral candidate from New York City. We've put in requests to other people. The Curtis interview made some news, and by the way, it's not quite a stock interview, but if you care about the economy, you care about who runs New York City going forward, because this is the epicenter theoretically of capitalism.
Hey,
so we've
went over.
Yes, we have extended interviews to Andrew Cuomo, who's seriously thinking about it, and Eric Adams. So
you also had a call into Mamdani. He hasn't returned your call yet, but he might later. I doubt it, but
it's been months now. In any event, thanks for tuning in. This is Charlie Gasparino signing off.
Bob Sloan, come back next week. We have a great show next week. Michael Koenigsberger, head of Gramercy Capital, one of the great emerging market and macro investors in the world. See you next week.
Next week.